Hey guys, did you know that not all IUL policies are created equal? This means that one IUL, meaning Index Universal Life policy, might have astronomical costs, whereas another policy might be fairly nominal in terms of costs. And this is really important. If you're thinking about an IUL, if you already have one, you're going to want to have it looked at just to make sure that your costs aren't too high. And the reason for that is because if costs are too high, if you have down market years, then the costs are going to start eating into the cash. And high cost policies are not optimized very well for cash value growth. So this is so important that I asked our IUL expert, Jason Herring, who's literally worked with hundreds of clients at this point, hundreds of these kind of policies, many different top companies, and he had a recent experience with one client and compared that client to another situation looking at costs. So he's going to discuss the two different companies, two policies, look at the extremes in the costs, and share that with you guys, share how these costs can show up inside of a policy and why it's so critical. So let's give Jason a listen in this example, and then I'm going to jump back in with you and give you just a few key steps to take. Jason?
Hey guys, Jason Herring here with Insurance and Estates, your IUL specialist. So today I thought we would talk a little bit about Index Universal Life and the fees that are associated with these contracts. Guys, I can tell you after 13 years now of specializing in index products, not all these products are created equal. There is a large difference between certain carriers, but especially when it comes to the fees that are charged inside these contracts. So what I thought I would do is give you a case study today. Within the past year, we had a 45-year-old male that came to us. He had been shown this illustration here from another agent with this product and was just asking me if this was a properly designed contract to maximize cash value growth. So the overall design of the contract was fine. It was a $15,000 planned premium for 20 years. You can see the premium coming into the policy here. It was solved for a very low death benefit. There's only about $200,000 of death benefit. So overall, the agent did a pretty good job of designing this contract. What they did not do a good job with is place him with a carrier that's going to help to keep his fees down so that he can maximize cash value growth, especially in the later years of these policies. So what I thought I would do is show you the main fees that are associated in these contracts and maybe compare them between carriers to show you the differences and how not all IUL contracts are created equal. So inside of every IUL contract, you have three main charges. You have the premium load, which is basically just the sales tax being paid back to your state. You are purchasing a product. You have your cost of insurance charges. And these charges, guys, are pretty low. You know, first year, $212 worth of fees coming out for a $200,000 death benefit. You know, not bad at all. You can see that with IULs, cost of insurance does go up as you get older. So that's something to definitely, make sure you keep in mind when looking at these contracts. And then the third charge is the expense charge. Now, every carrier has expense charges, and expense charges are mainly designed for everything that the company needs to keep the lights on and service your policy for the next 50 years. And expense charges are not equal. There's a big difference between expense charges with different carriers. With this particular chassis here, the expense charge started out at about $1,000 a year. By the time the client is 10 years into the policy at age 55, we're up to $3,100. By the time the client is at year 20, age 65, we're pushing $5,800 of charges. Okay. So look what happens the next year. You stop paying premium payments. You have $6,162 of expense charges. And let's say the S&P returns a 0% rate of return. Where is this charge coming from? How is it going to be paid? Well, it's going to come out of your account value over here. Okay. So that's why it's really important to make sure that your chassis, your actual contract, has low fees when you have those 0% years with an IUL, that you're not having large amounts of expense charges come out of your account value. The other thing that's very important to look at, and why this report is very important, is if the product is offering a bonus credit, which this product is, beginning here in year 11, you want to make sure these numbers are not inflating what you're seeing with your overall cash value growth. This product is illustrating a 1% bonus throughout the life of the policy, but the bonus is only guaranteed at 0.5%, 50 basis points. So you need to make sure that if you're using a product that's offering a bonus, that you're being illustrated those numbers at the guaranteed rates, not what the assumed rates are. Okay. So this is a pretty standard example of a cost and expense report that comes with an illustration. But this report only comes with an illustration if the agent goes in and decides to include this report in the illustration. This agent did not. So this client did not have any idea that by the time they're 20 years out, they're going to have these $6,000 and $7,000 expense charges coming out of the policy. So let's look at another example. This is the example. This is the product that we actually placed the client in. Okay, this is with Mutual of Omaha. So as you can see, we have a 45-year-old male. Preferred non-tobacco rates is what he received in underwriting. Minimum death benefit of about $263,000. And you can see that the 20 years of planned premium of $15,000. We have the premium charges coming out. That's the sales tax that's coming out. We have the cost of insurance, pretty similar. But look at the difference in expense charges. Mutual of Omaha has a $567 expense charge for this client within the first 5 years. Years 6 through 10, it drops to $162. Then by the time we get out to year 11, we're looking at a $60 expense charge for the life of the policy. So if you remember with our other client, at year 20, they had a $7,000 expense charge compared to a $60 expense charge with Mutual of Omaha. Guys, it is so important when you're looking at IUL concepts that you're doing everything you can to minimize expenses so that you can maximize your cash value growth. You're going to have 0% years. We can't control what the S&P 500 is going to do. But if I put you in a low-cost contract, I'm giving you every opportunity to maximize your cash value growth. Guys, we appreciate it. Let us know if we can help you. Have a great day.
Okay, well, thanks, Jason. Fantastic example. Could work for you guys watching. A couple things you can do now. You can go locate your old policy. You can see how much death benefit and cash value you have there. You also might want to consider emailing that policy to Jason at InsuranceandEstates.com. His email will be below wherever you're watching this video. Finally, his calendar link is going to be there, so Jason can be reached via his calendar. You can schedule a one-to-one if you want to have your policy looked at. We encourage that and welcome that. All right, thanks for watching, guys, and we'll see you in the next one.